Today, it's only just begun. Hello again, it's Martin North from Digital Finance Analytics with latest post covering finance and pro news with a distinctively Australian flavour. While US stocks and oil prices declined in choppy trading on Monday, while the dollar and the Treasury yields pushed higher as Wall Street digested a raft of mixed macroeconomic news. Global economic growth is slowing more than was forecast just a few months ago in the wake of Russia's invasion of Ukraine, as energy and inflation crises risk snowballing into recessions in major economies, according to the OECD. Global growth this year was still expected at 3%, but it is now projected to slow to 2.2% in 2023, revised down from a forecast in June of 2.8%. The OECD said on Monday, and the OECD also cut its forecast of Australian economic growth from 2.5% forecast in June to 2% in 2023. While Australia will avoid a recession next year, the OECD believes the Reserve Bank will hike interest rates up another 1.25%. The Paris-based Policy Forum was particularly pessimistic about the outlook in Europe, the most directly exposed economy to the fallout from Russia's war in Ukraine. Global output next year is now projected to be $2.8 trillion, lower than what the OECD forecast before Russia attacked Ukraine, a loss of income worldwide equivalent to the size of the French economy. The global economy has lost momentum in the wake of Russia's unprovoked, unjustifiable and illegal war of aggression against Ukraine. GDP growth has stalled in many economies, and economic indicators point to an extended slowdown, OECD Secretary General Matthias Cormann said in a statement. The OECD projected Eurozone economic growth would slow from 3.1% this year to just 0.3% in 2023, which implies the 19-nation shared currency bloc would spend at least part of the year in a recession, defined as 2 straight quarters of contraction. That marked a dramatic downgrade from the OECD's last economic outlook in June, which had forecast the Eurozone's economy would grow at around 1.6% next year. The OECD was particularly gloomy about Germany's Russian gas-dependent economy, forecasting it would contract 0.7% next year, slashed from a June estimate of 1.7%. The OECD warned that further disruptions to energy supplies would hit growth and boost inflation, especially in Europe, where they could knock activity back another 1.25 percentage points and boost inflation by 1.5 percentage points, pushing many countries into recession for the full year of 2023. Though far less dependent on imported energy than Europe, the US was also skidding into a downturn as the US Federal Reserve jacks up interest rates to get a handle on inflation. The OECD forecast that the world's biggest economy would slow from 1.5% growth this year to 0.5% next, down from June's forecast of 2.5% for 2022 and 1.2% for 2023. And meanwhile, China's strict measures to control the spread of COVID-19 this year meant that its economy would grow by only 3.2% this year and 4.7% next year, whereas the OECD had previously forecast 4.4% in 2022 and 4.9% in 2023. And the Dow Jones Industrial Average, the oldest of Wall Street's 3 main stock indices, dropped 1.1% on Monday, extending the decline from its January peak to more than 20%, meeting a common definition for a bear market. Whereas about the Federal Reserve's war against decades-high inflation is pushing the US economy into a downturn, have sent the US stock market tumbling this year. Now, it's worth noting that the Federal Reserve takes into account global factors like the strength of the dollar as it sets interest rates, although it ultimately makes policy decisions based on domestic goals, Cleveland Fed President Loretta Mester said on Monday. We've seen what goes on in financial markets. The mechanism will be through the financial markets and whether they're functioning or not, Mester said on the day of heightened financial market volatility that included a steep drop in the value of the pound. We're going to set monetary policy that's appropriate for the US economy, but we don't set it in a vacuum, thinking that we're an independent island and we're not connected to the rest of the world. With the S&P 500 and Nasdaq already down some 23 and 32% respectively from their record highs, confirmation the Dow is also in a bear market is just the latest milestone in 2022's market turmoil. While the Dow, with only 30 large cap companies, is much narrower an index than the other two, it is historically the one Main Street watches most closely. And to give you pause, compare what's happening now with the 2008 situation. Of course, history does not repeat, but it may well rhyme. Might we get a further bear rally before the next big leg down? On Wall Street, the term bull and bear markets are often used to characterize broad upward or downward trends in asset prices. Many investors use the term loosely, and analysts don't always share the same specific definitions, particularly about when to call the end of a bear market. Indeed, for professionals, these are just labels that are less important than fundamentals like company earnings and valuations, interest rates, and economic conditions. Some investors define a bear market specifically as a decline of at least 20% in a stock or index from its previous peak, with the peak defining the beginning of the bear market, which is only recognized in hindsight following the 20% decline. Similarly, some define a bull market as a 20% rise from a previous low. However, S&P Dow Jones Indices, which administers the S&P 500 and Dow Jones Industrial Average, has an even more nuanced definition. A drop of 20% or more from a high, followed by a 20% gain from that lower level, will leave an index still below its previous peak, a situation S&P Dow Jones Indices senior index analyst Howard Silverblatt describes as a bull rally in a bear market. Indeed, investors can only be sure they're in a new bull market once a new record high has been reached, and at that point the previous low would mark the end of the bear market and the beginning of the new bull market, according to the S&P Dow Jones Indices. Actually, the Dow fell on Monday after reversing early day gains as rising Treasury yields spooked investors amid growing fears of a recession. Treasury yields also rose to new highs. The 2-year Treasury yield, which tends to be the most sensitive to interest rate changes, rose to a near 15-year high of 4.315%, and benchmark 10-year yields jumped to 3.894%. In commodities, oil prices hit 9-month lows on Monday in choppy trade, pressured by a strengthening dollar as market participants awaited details of new sanctions on Russia. US crude fell 2.5%, and Brent last traded down about 2.5% on the day, and gold prices hovered near a 2.5-year low on higher Treasury yields and on a stronger dollar, while jitters over rising US interest rates dented appeal for non-yielding bullion. Spot gold dropped 1.2%. The dollar index, which tracks the greenback against a basket of 6 other currencies, climbed to a fresh 20-year high on Monday, making all commodities, including oil, which are denominated in dollars, more expensive for foreign buyers. Wall Street's so-called fear index, the VIX, was up around 6% on the day, approaching levels not seen since October 2020. Here we have investors hit from every which way. Ken Mahoney, Chief Executive Officer at Mahoney Asset Management in New Jersey, said, including inflation not seen in 4 decades, the Federal Reserve overreacting because they missed the opportunity last year to tap the brakes. Instead, they're slamming on the brakes, and with a stronger dollar, it's going to hurt earnings. The S&P 500 fell 1%, the Dow Jones Industrial Average 1.1%, and the Nasdaq was down 0.6%. Tech gave up its intraday gains, pressurized by an ongoing climb in Treasury yields, as Fed members suggested measures to slow growth, including rate hikes, increase the chance of the economy falling into recession. Atlanta Fed Reserve President Raphael Bostic said the Fed still has a ways to go to bring down inflation. Bostic's remarks come hours after Boston Fed President Susan Collins said higher unemployment will be needed to help curb inflation. Apple, however, weathered the storm to end the day roughly flat, following positive commentary on iPhone demand from JP Morgan, who cited a survey showing Apple's new product line is expected to fare better than the iPhone 13. Chip stocks also added pressure on the tech sector, driven by Nvidia, AMD, and Micron Technology, all down more than 2%. Utilities bond proxy that is less attractive in a rising interest rate environment also played a role in the market sell-off. Energy fell more than 2% as oil prices continued to tumble on worries that worsening global demand would further dent energy demand. At current levels, it appears the market is now pricing in the typical impact of a deep recession, ANZ Research said in a recent note, though added that the sell-off in oil could see OPEC intervene again. Halliburton and Baker Hughes fell sharply, with the latter down more than 5%. Consumer stocks, however, were the relatively outperforming sector on the day, lifted by a surge in casino stocks after Macau said it would resume visitation access from mainland China through tours and e-visas. Las Vegas Sands and Melco Resorts and Entertainment were all up double digits. In other news, PG&E Corp was down more than 1% as the company is set to replace Citrix systems in the S&P 500. With markets already jittery from central bank signals of additional interest rate hikes, UK government fiscal plans released last Friday continue to roil markets. Sterling slumped to a record low on Monday, and a renewed sell-off in British gilts pushed Eurozone bonds higher. I think everyone felt that they were swimming in a tsunami of news flow last week after one of the most incredible macro weeks in recent memory, Deutsche Bank wrote in a note. Global equities also fell on concerns about high interest rates and their pressure on the financial system, although a reaction to Italy's election, where a right-wing alliance won a clear majority, was muted. Europe's Stock 600 slipped 0.42% to its lowest level since December 2020. And Asian stocks outside of Japan fell 1.65%. On Friday, Finance Minister Kwasi Kwarteng announced he was scrapping the country's top rate of income tax and cancelled a plan to raise corporate taxes, all on top of a hugely expensive plan to subsidise energy bills for households and businesses in the UK. British government bond yields ripped higher in response, rising by the most in a single day in decades on Friday as investors ditched gilts, while London-listed blue chips hit their lowest since early March. Kwarteng on Sunday dismissed the free fall in the pound, saying his strategy was to focus more on longer-term growth and not short-term market reaction. And in Asia, trading on Monday, the pound fell by as much as 5% against the dollar at one point to a low of 1.0327. That's the weakest since the introduction of decimalisation in the early 1970s. The pound-US dollar fell to an all-time low against the US dollar as traders doubted the sustainability of the new UK government's economic plan. The Bank of England said on Monday it would not hesitate to change interest rates and was monitoring markets very closely after the pound plunged. Sterling last traded down about 1.14%. The pound's decline is partly due to dollar strength, which hit a new 20-year top of 114.58 in early trade, and it was last at 114.06, up 0.8%. In bonds, Eurozone government debt yields jumped to multi-year highs amid expectations that central banks will keep tightening their monetary policy. There's been an economic logic at play as central banks raise rates to drive monetary policy into restrictive territory, get below trend growth, for a while a polite way of saying a recession, and then you get lower inflation, said Sami Char, chief economist at Lombard Odier. The question is whether the financial world can go through that sequence. It feels like we are reaching the limit of that. Things are starting to break, for example, what we're seeing with sterling. European stock markets stabilised on Monday after recent losses, but concerns remain over a deteriorating economic outlook and raised political uncertainty. But in fact, the DAX and the CAC and the FTSE hardly moved at all. European equities have been under pressure, with the DAX down around 22% year to date as investors fretted over the toxic combination of high inflation, aggressive monetary tightening, a brewing energy crisis, and the economic consequences of the Russian-Ukraine war. Dismal business activity data from the Eurozone and the UK last week heightened fears of a regional recession, and investors will look for more information ahead to try and gauge sentiment in the Eurozone's largest economy. Investors are suggesting the victory of the right-wing bloc led by Giorgia Meloni in Italy's parliamentary election on Sunday. Meloni, who is set to become Italy's first female leader, has played down her party's post-fascist roots, and the country's benchmark FTSE MIB equity index climbed 1.5%, with domestic investors welcoming the result, given its broadly pro-business agenda. Elsewhere, global tension is mounting over the war in Ukraine as Russia holds widely criticised votes aimed at annexing territory that it's taken by force. Britain's home builder index hit a more than 11-year low on Monday on concerns that a weaker pound could lead to more rate hikes by the Bank of England, potentially hurting housing prices and demand. The house builder index fell 6% to hit its lowest level since March 2013. The weak pound is driving expectations for further rate increases, which means lower house prices, Peel Hunt analyst Sam Cullen said. Taylor Wimpey, Persimmon, Berkeley Group and Barratt all fell between 5 and 7.5%, pushing them to the bottom of the FTSE 100. Shares of Taylor Wimpey hit their lowest since 2014, Persimmon since 2016, and Barratt and Berkeley since March 2020. UK home builders, whose shares saw their worst times ever during the 2008-2009 global financial crisis, have seen government support come and go over the last few years and have had to contend with several setbacks, including Brexit uncertainties and more recently a $5 billion bill to remove dangerous cladding from buildings following the deadly 2017 London fire. They got a boost last week after the new British Finance Minister said stamp duty, a tax on home purchases, would be cut. However, there are some signs of cooling in the housing market and fears remain of an impending downturn in the sector as a worsening cost of living crisis and a steep climb in mortgage rates cast a cloud over demand. Taylor Wimpey last month flagged a softer sales rate for July, fanning those concerns. And Virgin Money and Skipton Building Society will temporarily withdraw their mortgage offerings, while Halifax has dropped its fee-paying products amid news of hefty tax cuts in the UK. Director of Demara Mortgages, Jamie Lennox, said uncertainty around the risk of an emergency rate rise would likely result in other lenders withdrawing products or increasing rates dramatically until they knew the extent of how everything would pan out. Others expected mortgage rates to soar, the Bank of England, saying that it would change interest rates as much as needed to return inflation to target. Now, in Australia, the S&P ASX 200 fell 1.6% on Monday to 6,469, weighed down by heavy losses across the energy and materials sector. The All Ords dropped 1.8%. The main index plunged to its lowest in 3 months in a global risk-off session that drove the pound to a record low as investors lost faith in the ability of policymakers to redress a weakening economy. The Australian dollar cracked below 65 US cents for the first time in more than 2 years. The local index has shaved 7% so far this month, and a break under 6,407 would take it to its weakest level since late 2020. Adding to the bleak outlook, Goldman Sachs slashed its target for US stocks and warned that aggressive central bank tightening will weigh on valuations. The energy sector was the hardest hit. It tumbled 6.3% in the worst daily decline since the pandemic started, as oil prices extended losses on recession fears. Beach Energy dived 7% to 147, Sanders dropped 7.3%, and Woodside Energy declined 5%. Miners were also hammered, with coal producers Whitehaven Coal and New Hope shaving off more than 14%. Whitehaven Coal collapsed to $7.91 in the largest daily drop in 18 months. The New Hope shares hit $5.40. Heavyweights BHP Group sank 5.2% to $36.20, and Fortescue Metals receded 4.9%. Rio Tinto shaved 5.7% amid allegations one of its iron ore workers had sexually assaulted a woman. Cerro Resources crashed 18.3%, and that was after advising its operations at its Balama graphite project in Mozambique has been interrupted by illegal industrial action. An ECP investment management flagged evidence of cracks forming in corporate profits, warning the quantitative outlook is becoming increasingly cautious. Although national retail sales data points to robust consumer sentiment and recent reports have shown record high sales volumes, consumer confidence has been deteriorating and corporates are preparing for a recession by reining in budgets, said partner Damien Callaghan. He noted that as a result of increasing inflationary pressures, corporations have begun pulling back on labour hiring plans, and some already announced job cuts, particularly in the software and technology sectors. Link Group was dealt another blow as investors reacted to the collapse of a $2.5 billion buyout by Toronto-listed Dye & Durham late on Friday, with the shares now less than half the value of a public float back in 2015. They fell 7.8% to $305. Shares in gambling giant The Star Entertainment pulled back 2.6% to $263 following the departure of acting CEO Jeff Hogg after an inquiry found the company unfit to hold a New South Wales casino licence. And Chairman Ben Heap will step into an executive chairman role to cover CEO duties until Mr Hogg's successor, currently Tyro Payments boss Robbie Cook, joins Star. And private hospital operator Ramsay Health Care crumbled 2.4% to $59.08 after it officially ended talks with private equity group KKR's consortium as the value gap between the two widened. And backing the trend, though, healthcare and consumer staples stocks rose. Nuconics jumped 4.7% to $358 after touching its lowest in 3 months, and Megaport achieved 3.7% to $744. And this morning, a 1.1% advance for the materials sector has helped lift the benchmark ASX 200 0.2% in early trade. Coal miner New Hope is up 4.6% after heavy losses on Monday, with iron ore trio Rio Tinto, BHP Group and Fortescue all higher. The energy sector has also rebounded, with Woodside and Santos both higher. And British bank Virgin Money is down 4.6% as the UK pound collapses on the back of a shock mini-budget in the country. And Ramsay Health Care is also lower again this morning after KKR pulled their bid. And the Australian dollar has gained a little ground this morning at $64.80, but is still well down. So the point here is that we're now getting into the ugly part of the down cycle. And this is going to travel over the next couple of months significantly further south. And as I said at the start, there's a lot more bad news to come. So things are going to get worse from here. Maybe it's too late to get out, maybe not. But I think at the moment holding cash is not a bad view. But of course then the question is, where do you put that cash for safety? Well, that's probably to be addressed in another post. And you can join us this evening as Damien Clash and I talk about the latest on the markets on our live stream, which starts at 8 p.m. Sydney time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.